Concerns over inflation are mounting amid disruptions in global supply chains. For more on the economic front, that is, as we learn to live with COVID-19, I have Professor Song Soo-young from Chungang University. Welcome back, Professor Song.
Thank you for inviting me.
I also have Professor Kim Se-wan from Ewha Women's University. It's good to see you again, Professor Kim.
Thank you for having me.
Right, Professor Song, Korea's Consumer Price Index surged to 3.2% on year back in October, the highest since January 2012, I believe. What are your prospects for the months ahead?
Actually, I believe I'm still in the transitory team, so which means that the current situation of inflation is because of the disruption of supply chain, so which by nature, which is temporary and transitory. But whether how long it will take, but less than 2 years would be most likely. So when I look around the current situation in Germany, they have experienced 4.4% of inflation rate in October, which is just 28 years ago, which was 4.3 percentage points. And in France and in Britain, they have a food shortage and some boiler system problems. But when I compare the data, particularly in Korea, it was comparable period of inflation, particularly the producer price index and CPI, excluding the energy and food price. That is in the aftermath of a great financial crisis in between the 2009 and 2010. The inflation rate was almost 4%, which is comparable to current inflation rate. Therefore, soon it will disappear, and I think current situation is very similar. When we look back the history, this is very close to the situation in 1950 when the Korean War broke out. Then United States has experienced a surge of inflation, then it faded out within 2 years. So I think that is comparable era, and I do not have much of concern about the inflation.
Right, so for Professor Song, in your view, it's just a phase that we will weather out.
Right.
And Professor Kim, what are your thoughts now on the causes behind rising consumer prices?
There are two forces that drives up price level. One is demand side, and the other is supply side. And these days, these two forces together boost up domestic inflation, which becomes almost perfect situation of the inflation. A global supply chain, as Professor Song talked about, and soaring raw material prices, particularly in oil price and coal prices, are external factors of higher inflation. Oil price is really skyrocketing from last year. The price of the international crude oil was $30 per barrel in March of last year, but it is over $80 per barrel, increase over 260%. At the same time, from inside of the country, the demand for goods and services are increasing quickly, represented by 4% economic growth. And at the same time, really enough liquidity has been provided to save the economy in the past 2 years. And lastly, rising 전세 prices and housing prices is another major factor of inflation.
Right here in the country, of course.
Right.
Professor Song, topping national headlines in recent days is the shortage of diesel exhaust fluid. What are your thoughts on this and on the broader implications of this shortage?
I think this is not related with the inflation issue because of a sudden disruption of supply, particularly the import from China has been disrupted because Chinese government has banned on the export of these urea, which is carbamide, so organic compound, but it's very essential particularly for the fertilizer. So that's why the Chinese government has banned so this cannot be resolved soon. So we have to find some diverse and various supply of these urea solution, so which is essential to reduce the pollutants, particularly from the nitrogen and nitrogen oxygen from the exhaust from the diesel engine. However, still, this could have some impact on the economy. But however, this could be resolved not soon, but this shows us some kind of danger when we have some totally offshoring. Some supply from foreign countries could be an obstacle and could have a damaging effect on the economy, particularly even though it is a temporary disruption. So we have to change, and must have the government should take care of this situation, and then long-term strategy to avoid this kind of disruption in the future.
Right. And Professor Kim, to ease inflationary pressure, authorities are poised to cut taxes on fuels by 20% starting this coming Friday for the next 6 months. And as you mentioned earlier, consumer coupons are being handed out to spur spending. How do these measures look to affect economic recovery while seeking to stabilize prices?
Well, with current packages of policies between stabilizing inflation and recovering economy, it won't be easy to stabilize inflation in the short run. As we talked about, one of the most influential factors of high inflation is oil price, and when we pay for gas, 50% is tax. So, for example, when we pay like 10,000 won for gas, 5,000 is tax. So it was timely action of the government to adjust fuel taxes for stabilizing oil products prices. However, it is highly expected that oil price goes up for a longer term, and quite a few major prices has been increased, like transportation prices and agricultural prices and electricity prices. So I think the current package of government policies to stabilize inflation is not strong enough to stabilize inflation in the short run.
Right. And now for a broader understanding of current inflationary concerns, we turn to the US, where a recent consumer survey by the Federal Reserve showed inflation prospects hitting a fresh high for the coming year. For more, I have Professor Robert Deckel at the University of Southern California live on the line. Professor Deckel, it's a pleasure to have you with us.
Yeah, thank you for putting me on your show.
Right. Professor, do start by sharing with us details of the central bank's October survey of consumer expectations and a bit about the reasons behind them.
I see. So this survey was performed by the Federal Reserve of New York, and it's an internet survey of 1,300 or so households or consumers, and they give their impressions of what the inflation rate is going to be a year and also in 3 years. And those are higher. Those are quite high. I mean, the short run, it's 5.5. In 3 years, it's 4% or so. So those are pretty high expected inflation figures. And it's highly concerning, because what the Fed in Washington didn't want, and what economists like us don't want, is that inflationary expectations of households get embedded into the system. Because if you think that inflation, say, is going to be averaging, say, 4%, okay, it's a little bit even lower than this Fed survey, then people will, like small businesses will raise their prices by 6%. Wage earners would demand 6% increases because they say that prices are going to increase by 4%. I have to, so everyone's going to be raising prices because they expect prices to go up, and that gets kind of embedded into the system. And if these expected prices get very rigid, it's going to be very hard to bring down the inflation rate unless you have a sharp recession. And so overall, it's quite concerning, and it's quite concerning that these survey numbers are quite high. So that's my take on these recent consumer surveys. Yeah.
Professor Deckel,
it's very worrisome.
Right, it is, of course. There's been a bit of talk also about the term transitory that the Federal Reserve has earlier used to describe the current US inflation. How do you respond, Professor?
So as the two gentlemen spoke about the Korean situation, the transitory part is the same. Supply chain disruptions. In the U.S., there's, workers aren't going back to work because the unemployment benefits were just very generous until early October. So you have a labor supply shortage. Oil prices, commodity prices have gone up. Shipping, it's because of COVID, shipping from Asia into the United States, Korea and China into the United States have been disrupted. The Suez Canal crisis has disrupted shipping. So for those reasons, yes, there are supply distortions, and those are transitory, but transitory of a year, maybe 2 years even. But what's even more concerning, so that's the supply side, and a gentleman just mentioned on your panel that there's also the demand side. And the demand side is more concerning because the Fed just keeps on printing money. And, this is, as Milton Friedman, who's a famous kind of monetary economist, has said, inflation everywhere is a monetary phenomenon. And the Fed has just only recently, like a few days ago, announced what's called tapering, or they're not buying as many government bonds. So finally, they've announced that money supply is going to be increasing at a slower pace, but it's than before. But it's still increasing, and that's a big concern. And so that's why households expect inflation rates to be 4% over the next 3 years. Even the 10-year inflation rate that you can calculate out of spreads between inflation-adjusted bonds and regular bonds lies at about 2.7% over the next 10 years. And that's almost never has been above 2% for quite a while. So even market participants, the investment community, think that the inflation rate over 5 to 10 years is going to be much higher than what it was before in the U.S. So these are quite concerning developments from my perspective and the perspective of many economists here.
Right. Professor Deckel, given what you've said so far, then I am assuming you are then in support of the Fed's decision to begin tapering bond purchases later this month as part of efforts to pull its pandemic aid out.
Yeah, absolutely. I'm in support of that, and in fact, I think it was too late, but it's better late than never. But the pace is going to be really slow. There's tapering that's starting, and it might be well within June or so until the Fed buying of long-term bonds is stopping. But it's still on their balance sheet. They're not getting rid of this stuff. They're just buying less, but they just still own these government bonds. And then only at that point will there be any consideration of raising the federal funds rate or the interest rate from nearly zero to 0.25. I think the market now thinks that there'll be 2 increases next year toward the end.
I see.
Quarter percent each. So it might, by December, it'd be 0.5%. December 2022. Right. So that seems to be the market expectation. But I mean, there's a lot of factors, that I think are behind the decision of the Fed.
Right.
To be very late in raising interest rates.
Right. And staying with that particular decision, Professor Song, what can you tell us about the wider implications of the Federal Reserve's tapering process, especially here on the local market?
I believe this tapering is, I agree with that. This is, even though Professor Deckel is better late than never, but actually during the outbreak and aftermath of the coronavirus outbreak, I think June is too early to start tapering. So I think this would be a proper time. But As for the long-term inflation rate, that would be embedded among the demand side consumers. That would be a problem. But I don't think, because according to the press release which was made on 3rd of November by the Federal Reserve, they allow the inflation rate higher than 2% average. So because unless it becomes some very high and long lasting, they will maintain the current interest rate. So that is the point. So the long-term inflation rate, even according to the calculation, that would be I think Federal Reserve board directors also believe that would be a temporary. And recently I have just checked Wall Street Journal and what happened to the Western Texas Intermediate oil price future. That has been stabilized around $80, and so because of that, I think as long as and also the Professor Deckel has mentioned the truck drivers will not return to what they used to have the job. So that is called great resignation. So which means that people now they become aware of how harsh their previous job was. That's because they do not want to go back. So that caused some shortage of the labor supply. So as time goes by, I think that will be resolved, and there's a disruption of the supply and the disruption of labor supply also will be resolved sooner or later. So,
right, hopefully.
Yeah.
Professor Deckel, very briefly speaking, the Fed's actual announcement on intentions to begin tapering came last Wednesday, and the announcement itself did not rattle the markets, with the US stocks finishing up actually. How do you explain this reaction from the market?
Well, it was less aggressive than perhaps what the market anticipated. Like when interest rates rise or money supply growth slows, the market's going to fall because interest rates and bonds become an alternative for stocks. So people start to move toward bonds and savings accounts and safer assets, right? So if the Fed starts raising interest rates and their tapering slows, then bond interest rates go up and people will shift their stocks to bonds. But since the tapering is quite gradual, bond interest rates didn't rise as much. It's still like 1.53. It's gone down a little. That's why people are still holding stocks and buying them. Also, with the inflationary expectations going up, the return you're getting on bonds is negative after you subtract the inflation. Also, bank accounts are not earning anything, so people are losing money, putting their money in just your savings account. So everyone is taking a little more risk than they should by going into the stock market. And so that's why it didn't go down. In fact, it's gone up the last week because the Fed was more dovish, softer than what people anticipated.
Right, it was. All right, Professor Deckel, thank you very much for making the time to join us live at this hour with your thoughts.
Okay, thank you so much. Yeah.
Right, well, back here in the studio, Professor Kim, the Kospi, starting from early October for its part, has been hovering below the 3,000 mark. What can you share with us about the sentiment of the local stock market?
Well, I think the major difference between robust U.S. market and Korean market is on the differences on major companies' business performances. U.S. market, for example, notched its highest level as investors became happy with great earnings report of the major companies. But on the other side, in Korean market, we do not see impressive earnings report of major companies. In the case of the United States, U.S. investors are also worrying about the higher inflation and broken global supply chain, but they are pretty happy with major companies are getting over this difficult situation. But in Korea, we are worrying about the higher inflation also and higher possibility of raising interest rate by central banks. So our stock market is going under adjustment period, for example, for a while.
Right, and talking about central banks raising interest rates, Professor Song, what are your prospects for a further hike in our benchmark key interest rate later this month?
In Korea?
Yes.
I think many press and the people anticipate some rise of interest rate, but what I would like to say is be careful and not to put down on some recovery of the economy. Otherwise, already we have some problem with some supply disruption and other issues. So I believe this would be too early to raise the interest rate. So I believe according to Fed, actually, in the press release, they have set up some priority of concern of the Fed is public health, labor market, and the inflation rate and expected inflation and the financial and international market. But in Bank of Korea do not have such order of priority. So that creates some divergence and a different approach between the Fed and Bank of Korea when they look on some current economic situation. So I'd rather advise them not to raise the interest rate and wait until next time, because as early as January or February, we are going to see some indicator what happened to the oil price and how the supply chain disruption can be resolved. Then so that would not be it cannot be too late to raise
Right,
interest
so
rate.
you would propose a wait and see approach.
Right.
All right, Professor Song, as always, thank you very much for your insights. And Professor Kim, thank you very much for your thoughts today.
Thank you very much.
Yeah, thank you.